If you're new to income-based options trading, you're probably still trying to get used to placing trades on a sell-to-open basis. Compared to writing covered calls, put selling is quite different. If you haven't spent a lot of time with put selling, you might struggle a little bit to understand the reasons and risks associated with put selling. Because put selling requires a higher level of options trading authorization, it is almost automatically assumed that put selling is a risky strategy. You may have even heard your broker or investing advisor tell you that put selling was a very aggressive investing strategy. That is a true statement, but only if you are willing to sell puts naked and not following the approach we'll outline here. Here's why brokers and investment advisors want everybody to believe put selling is risky. Suppose you sell a put on a $50 stock with a $50 strike price. Remember that selling a put option means you are giving somebody else the right to sell the stock back to you at the option strike price, $50 in this case. By the time expiration day comes, the stock has dropped all the way to $35. You will be assigned the stock at this point, and you will buy the stock at $50 per share, because the strike price is the price you are contractually obligated to complete the trade at. Right out of the gate, you're down $15 per share or 30%, not counting the premium you brought in when you opened the trade. This is where brokers and investment advisors stop for a dramatic pause to let you react emotionally to the idea of such a big drop. And then they follow up with something like, "Nobody wants to have to take that kind of loss." The truth is that the very dramatic picture I've just painted absolutely does happen on occasion when put selling is part of your income generation strategy. Fortunately, for anybody who really pays attention and understands the opportunity a put sale actually gives you, this truth also goes much further than advisors and brokers are willing to tell you about. The picture is much bigger than the limited view I've given to this point, and the fact is, a lot of investors are either too ignorant or are unwilling to exercise the patience and diligence a successful implementation of put selling requires. Let's expand the view of our example trade a little more. Suppose now that before you placed the trade you noticed that the company had built a solid reservoir of cash as reflected by its free cash flow. You also noticed that earnings had been increasing on a consistent basis along with revenues, and that what debt the business carried was clearly contained by a low debt-to-equity ratio. Additionally, the stock paid an annual dividend of 2%. Because the stock is at historical lows, you also notice that its price-to-earnings ratio is quite a bit lower than the average for its industry. Given the fundamental strength of the stock's business, the likelihood that the stock's current poor price performance is being primarily driven by simple buying and selling dynamics in the market in general, rather than on any real problems with the stock itself, is pretty high. Remember that every stock experiences cycles between highs and lows, which means that a fundamentally strong company with a stock price at historical lows should be viewed as a solid growth opportunity in the long term. This fundamental information is also the kind of picture some of the most successful investors in the history of the market, like Warren Buffett, Benjamin Graham, and a host of others, have looked for as they built their own fortunes. It's an approach that you might recognize by its popular name, value investing. A practical way to use put selling as a conservative method to generate income is by combining the techniques of put selling with the discipline and patience of value investing. This is a combination that gives you a way to generate real, useful, and above-average income while at the same time managing risk in a practical, long-term way. Stocks that are already trading at historical lows provide better odds of an increase in price than a stock that is already running at historical highs from a long-term upward trend. For put selling, this provides an excellent chance that the stock will stay above the strike price of the put option at expiration. So if the option expires worthless, you can move on to the next trade. If the stock's fundamentals are still strong, you can often find multiple opportunities for additional put sales on the same stock. You can also try to maximize the possibility that the option will expire worthless even more by selling put options that are at least 2, 3, or sometimes even 4 strike prices out of the money. This approach has historically provided excellent opportunities to reap an average 2% return on investment or more on a monthly basis. We actively screen the stocks we use for the trades we publish in our blog, and that we place ourselves based on their fundamental strength to find stocks with a clear value-based advantage. Selling a put also provides a gateway to the second part of our income generation system, which is selling covered calls. Since we only sell puts on stocks we like and don't mind owning at the strike price we sold, why not use the ownership that comes from a stock assignment to generate even more income from the stock while we can? Selling out-of-the-money call options is a great way to keep generating income while simultaneously lowering our cost basis. It also makes it easy to set up a net profitable scenario if the stock closes above our call strike price at expiration. Another truth is that just because a stock is at historical lows and may be consolidating at pivot support, it isn't a given the stock will go up. There is, frankly, an equal chance the stock will drop below the strike price we've sold. That is why another critical part of a conservative income system stipulates that the strike price you choose for a put sale is a price you are willing to buy the stock at. You must sell puts with the clear understanding that you may be forced to buy the stock at that strike price. If that price level doesn't represent a great value by your analysis, you shouldn't sell the put at all. Seeing the stock drop even several dollars below our put's assignment price won't scare us out of a trade, primarily because of the fundamental strength our system is designed to screen for. In the case of these extreme trades, it usually just means that we need to exercise a little more patience and be very cautious about selling calls against the stock. If the stock appears to be consolidating or building some bullish momentum, we'll often simply hold on to the stock until it starts to move back up into the general price area we were assigned at. Clear downward trends may provide opportunities to sell out of the money call options to keep lowering our cost basis within just a couple of weeks or less to expiration. Dealing with stocks that have dropped significantly below our put option strike price is what requires the most discipline and patience. It requires diligence to track the company's fundamental news and earnings information. The only reason we exit a stock at a loss is when we can see a serious degradation in the fundamental strength we identified at the beginning of the trade. Fortunately, it just isn't that common to see a well-run and effectively managed company suddenly stop being well-run and managed. That means that if you're applying the method correctly, this should be a rare exception to the norm.